This is Season 3 of Grain IQ. I'm your host, Chad Moyer. Grain marketing is a critical piece in keeping your operation profitable. In Seasons 1 and 2 of Grain IQ, we covered the basics of grain marketing and how to put those concepts into action. If you haven't listened to those first two seasons, we invite you to start there. Grain IQ is a project of the Nebraska Rural Radio Association and sponsored in part by the Nebraska Soybean Board and your Nebraska Soybean Checkoff. Today we're going to continue our series and taking a look at kind of what's the situation in country elevators and how does that play a role in grain marketing. Here to talk a little bit about that and kind of highlight a report that he did recently on that issue is Tanner Ehmke. He is a Grains and Oilseeds Economist with CoBank. Tanner, thanks for visiting with us here today. Before we start talking about your report and talk a little bit kind of about the situation and again how country elevators play a role in this marketing of grain, tell me a little bit about CoBank and the role that CoBank has in agriculture.
Well, thanks, Chad. Great to be with you. Great question. What is CoBank? We're part of the farm credit system. And farm credit is the lender to about 40% of the agricultural industry or more here in the U.S. CoBank's role is dual purpose. We are first a wholesale lender to farm credit associations. So the money lent out to farmers and ranchers through the farm credit associations that they belong to comes from CoBank within our district at any rate. That's the western half of the U.S. and up in the northeastern U.S. And then our other role within Farm Credit is we are the bank for cooperatives, thus our name, CoBank, Cooperative Bank. We started out as the National Bank for Cooperatives, and today our name is CoBank. And so farmer-owned cooperatives, again, if you market your products through a co-op, a very strong possibility you are, by extension, a customer of CoBank. So those are our two main roles within Farm Credit, and that gives us an advantaged view of what's going on in the agricultural economy from around the United States. We are the bank for co-ops of all kinds of commodities, from almond co-ops out in California to citrus co-ops in Florida to corn, wheat, and soybean co-ops across the Midwest. You name it, we are very likely the bank for those farmer-owned co-ops.
Yep. And there's something that CoBank does, and it maintains there's this little, maybe it's not a little, but it is a division of CoBank. It's called the Knowledge Center, and try and disseminate information about what is going on. What is the goal of the Knowledge Center? What do you guys do within that part of CoBank?
Our official name is Knowledge Exchange Division, and we call it KED, or Knowledge Exchange. And we are the research arm of CoBank. Our role is to provide research and market intelligence internally to our decision makers and to our relationship managers in regards to the markets that they are concerned about or that affect them with their borrowers, and then also to be a service to our customers. With our borrowers that are dealing with risk mitigation, as it were, with so many things going on in the world, if we're interest rate risk or commodity risk or anything that affects their business operations, we're there as a service to provide some intelligence on those matters.
Well, let's talk about an article that you just recently posted to the Knowledge Exchange. The title of it is called "Grain Storage Outlook Improves for U.S. Elevators, but Bushels Remain Elusive." Again, we'll talk a little bit about the content that is therein and some of the findings that you found. But I guess going into this report, what were you attempting to uncover? What was kind of the purpose of this group of research data points, if you will?
We'll go back a couple of years, Chad, and things were remarkably different compared to where we're at right now in grain markets. We were tight on inventories for corn, wheat, and soybeans, and markets were inverted. And if you aren't familiar with what that term means, in the futures markets, in a surplus environment where you have plenty of bushels to go around, and that is the ideal situation for co-ops especially. And farmers, they need bushels to sell. In that market environment, the nearby price and the futures curve is going to be lower than the prices of the deferred contracts. Okay. In that market environment, the market is literally paying you to store those bushels over time. Okay. Thus, the wider the spread, the more of the incentive to store those bushels. And that's the business a co-op is in, is to store bushels. That's why they have storage. That's their main game. And then marketing those bushels through transportation, and booking transportation and finding arbitrage opportunities perhaps throughout the country. Well, in the prior couple of years, we were in an inverted market situation where those nearby contracts were priced higher than those deferred contracts, the ones that priced at a later date, thereby strongly disincentivizing storage. That's a problem for co-ops. When the co-op is there to provide that service of storage, well, the market is saying, don't store it, get rid of it. Okay, so that was a very stressful environment for a lot of our borrowers. It's hard to make money when the market is penalizing you for storage. Okay, so over that couple of years of an inverse in the marketplace because of tightness in global corn, wheat, and soybean supplies, co-ops had to reinvent the business that they were doing. They were booking transits in rail cars and trucks. They were basically almost freight brokers, if you will. And at the same time, they were trading bushels. They could not store those bushels. So it was almost hand to mouth. Get those bushels in, get them out, move them. And they were active grain traders trying to make margin on bushels. And that was hard to come by. Well, then all of a sudden, now we're back into a surplus situation where we have a very big corn crop, record large corn crop. The wheat crop is bigger, although we had a drought in much of the plains. This total U.S. wheat crop was bigger this year than it was last year. Soybeans, we had a record crop down in Brazil, and that disincentivized our exports. And so globally, we had surplus there as well. So we were back into a surplus situation where the spreads are now favoring storage, and that is to the benefit of our co-op customers. Okay, so the market situation changed remarkably from that inverted marketplace where the market was penalizing storage back into a normal carry environment. That's what that spread is called, is carry, where the elevator can now profit on their storage. The market literally pays them to hold those bushels over a period of months and then sell them again, or to market them. So at any rate, that situation changed the entire tenor of the marketplace. Unfortunately, as we're talking right now, Chad, we're dealing with some situations globally with South America and their weather situation. We're looking at smaller corn acres next year in the United States, smaller soybean acres. And so now we're back into a situation where those spreads are coming back in again. And that profitability of storage is now not what it once was.
Yeah. And maybe we can take just a half a step back and just remind us, where do country elevators, the people that you serve, the people that you work with, where do they sit in the value chain? And kind of, again, what is the purpose as you see it for the country elevator? How do they play a part in marketing that grain?
Let's go back to the origination of the idea. Why a co-op? Why can't farmers just do all of this themselves without having the cooperative there? Well, go back to, so many decades ago, how many generations ago, when farmers were populating the plains and they were at the mercy of the railroads. Okay, they were out in the middle of the plains and had crops to sell, but they didn't have the assets they needed for transportation and storage, and so they were at the mercy, really, of the trains, the rail companies. So with a co-op, the farmer now had collective bargaining, if you will. They could pool their resources, and they can now have those storage and transportation assets, where now they could actually have some more market power. That was the genesis of so many of those co-ops. Later on, with the mechanization of agriculture, we needed fuel to fuel tractors. We're no longer feeding oats to horses. We're running diesel fuel through tractors. And so a lot of the co-ops were started as petroleum co-ops to get that petroleum, to get the diesel to run the tractors. And that, again, the farmer wanted collective bargaining for that. So really it all came down to farmers around the country, 100 years or more ago, wanting to increase the value of their crops. And so thereby getting that through collective bargaining. Where is the co-op today in all of this? A lot of those concepts are still around. A farmer can't just easily build a rail spur out to their farm. That's just not financially doable, or is it logical? So the co-op still has that transportation value add there for the farmer. They can still order trains. They can still add a rail spur. They can still bring access, bigger, broader market access to the farmer around the world, more so than what a farmer can do. So again, that is still a value proposition for the co-op of bringing global market access locally back to the farmer. And then as time goes on, look at all these issues that we're dealing with globally with uncertainty in marketing. The co-op is still there as a resource to help a farmer market, providing numerous marketing opportunities or marketing services, forward contracts, delayed pricing, things like that a farmer can use to manage their price risk. So the value proposition is still there, but it's growing. The farmer services need to be there, whether a farmer needs fertilizer or application services. A lot of our co-op borrowers have grown into those spaces and providing technology services. Maybe perhaps you need somebody to take a drone image of your field, providing those type of services, or even healthcare. Even it's continually expanding to provide services to farmers that those farmers may not get affordably on their own.
Very good. Thank you so much for that background. And again, I think it paints a picture of kind of where we're at. And again, the importance of the situation. Now let's go back to your article and this idea, how much grain, or is the market giving you signals on whether you should store grain or not? Now, you said before that it was a production issue that led to this inverted markets. Is that the only thing that influences a market to give a storage signal or not, or what are the factors that go into that decision making, do you think?
There's always going to be those global factors that affect futures markets, and that's going to be the main thing you're going to be looking at on the Chicago Board of Trade, or the CME group, and that is the spreads between, say, for instance, a December corn contract and a March corn contract. What is the market going to pay you to store that commodity? But we need to take the discussion another step. We need to talk about basis, and that is the measure, or that is the tool that the local elevator has that for a local price signal. And the basis is the difference between their local cash price and what is quoted on the Chicago Board of Trade. CME Group. Old habits die hard. I came from the Chicago Board of Trade, exactly. So that's I keep falling back to that. But so anyway, it's the dual price signals, not only of the futures spreads, but also the basis, and that's something that farmers oftentimes aren't watching as closely, even though it is also quite important as well in their marketing plans. A farmer can also use basis contracts with their local co-op as a means of hedging or as reducing their price risk. So that's something that has to be watched as well. And that's going to be affected mostly on local supply-demand issues. Let's say there's more and more demand locally for corn or soybeans because, let's say, a new ethanol plant is constructed, or a new crush facility is constructed nearby, thereby pulling up or thereby using more of the local commodities. Well, that's going to tighten local cash prices relative to the Chicago Mercantile Exchange, the CME, and narrow that spread between local cash price and the futures, and thereby tightening the basis. So I would say it's both of those signals that farmers need to keep an eye on. It's not just the board price, but or the board spreads, but also what's going on with basis.
Yeah. And I think that's an important thing to talk about, too. I was going to ask you about that because we do have a situation. Again, this is reflecting of what's going on at the end of 2023 going into 2024. But like you said, the futures are giving us some carry opportunities. But at many end users and elevators, for that matter, the cash price today is at or even better than a bid 3 or 4 months out. So I would say, and I'm no economist, but that tells me there still is a lot of worry and uncertainty going on in some of these markets right now, huh?
Yeah, the trend that we're seeing with our customers in grain co-ops is farmers have been selling soybeans for cash. If they need cash, then they'll sell the soybeans because soybeans are priced relative to corn quite a bit higher because our soybean crop was smaller this year. And there's some uncertainty about what's going on down in Brazil because of the drought there. And so there's some uncertainty there. The market has rewarded farmers with higher prices. The problem, though, is on the corn side. And we had a record large corn crop. We had a record large here in the United States. We had a record large corn crop down in Brazil. So that has been an issue for farmers, for a lot of concern that perhaps we're not going to see the prices that we saw earlier this year when farmers we're looking at the price of corn around $6.50. Well, that's really no longer the case because we're long on corn bushels in this country. So that has caused a lot of worry and concern about where corn prices are going. Are we going to be able to see a recovery back above $5? Right now, we're about 20 cents under what the board is where the board or under $5 on the board, and add in where you might be with local supply. If you are long on bushels in your local area, then that's going to further depress your local cash price. And so there are some farmers that are really looking at very low cash price that is very concerning. So they're holding on to those corn bushels, waiting for a rally.
All right. Let's go back to your article, I guess. Give me what are the main 3 things that you want producers to understand about the situation that grain elevators are in? Again, kind of what, as you take a look at this topic, what did you find out? What was the most interesting for you?
Well, the most interesting thing is that although the carries are back in rewarding storage, farmers aren't selling. That is a problem. The grain elevator needs to own those bushels. The company has to own the bushels in order to capture that carry that's in the futures market. If they're not able to do that, they might be able to make that up on storage fees with the farmer by charging the monthly fees or by offering delayed pricing, which is a fairly risky proposition for the elevator. Delayed pricing is when the farmer transfers title of those bushels over to the elevator, thereby enabling the elevator to price those bushels and hopefully capture some carry in the futures market. The problem and the risk to the elevator is that they may do so at a loss. It is a much higher risk because those bushel, the buy basis is unpriced. Mm-hmm. So in a carry market, that is very risky for the grain elevator. And so as a result, they need to charge for that service accordingly. And it cannot be at the same rate as charging a regular rate for storage, a few pennies a bushel per month. They need to increase that cost of that service on those DP bushels because of the greater risk of holding bushels in a carry market.
You've said it before, agriculture is changing from when the co-ops were organized to provide that market power, that they have, the purpose of them has changed, or that has moved a little bit. So I guess, where do we sit right now, and what are some of the things that could change, could influence that change in marketing grain as we go forward? We mentioned the soybean crush is one thing. What's going to influence this moving forward, do you think?
Soybean crush is number one, as you mentioned. We're going to continue to see over the next few years that be the main driver. We still have to look abroad about what's going on down in South America. They're adding crush capacity as well. We have to take a look at what's going on in Argentina. They're the world's biggest exporter of soybean oil and soybean meal. With all this additional crush capacity, we have no problem finding a home for the vegetable oil or the soybean oil. We know where it's going. It's going into renewable diesel. The issue is finding a home for the finding a home for the soybean meal, and those trade flows are now being are materializing, and those we're finding a place in the export markets, and we're going to continue to do so over time. And I would say that other crops are going to potentially lose acres to soybeans because of this. Now, how much do we plan to, can we anticipate to lose out of wheat or other crops? I'm not expecting a wholesale shift all at once, but over time on the margins, we're going to see some acres shift over. I was just in South Dakota here last week, and they're bemoaning the loss of a key key insecticide for sunflowers, horseman, and so they're anticipating losing those sunflower acres over to soybeans, and so on the margins we're going to see that happening, and it's not going to be a wholesale shift over to soybean acres, but some acres here out of some crops, some acres over there out of some other crops, and that's probably what we're going to continue to see manifest over time. And then, of course, across the border over in Canada, we can't forget about canola oil. They're expanding their crush capacity in Canada as well to serve this to backfill this demand for vegetable oils in the United States, specifically on the food side. So really, I think here centrally to all the row crop or to the grains and oilseeds, it's all about renewable diesel and how we're going to shuffle around the trade flows and the acres around it.
Very good. Tanner, it's good to have you on the podcast. Thanks so much for joining us today, okay?
Chad, thanks for having me on.
Absolutely. Again, we've been visiting with Tanner Ehmke, a lead economist for Grains and Oilseeds with CoBank, joining us here on today's Grain IQ podcast. Thank you so much for listening, and we'll look forward to seeing you on the next podcast.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Makovica. Our project manager is Bryce Duskett. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.